Right now, there's a number sitting in your bank's computer system, and the second your account crosses it, a federal report gets filed on you. Automatically. No letter, no phone call, no warning. But that's not even the scary part. The scary part is what almost everyone does the moment they find out that number exists. Because the instinct that feels like protecting yourself, it's actually a federal crime. Stick with me, because by the end of this, you'll know exactly how to move your own money without ever tripping a wire you didn't know was there. Here's the number, $10,000. Under a law called the Bank Secrecy Act, every bank in America has to report any cash transaction over $10,000 in a single day. It's called a currency transaction report. Your bank fills it out, sends it straight to a federal agency, and includes your name, your social security number, your birthday, your address, and the exact time you walked in. You'll never see it. And here's the part that surprises people most. Your bank is legally forbidden from telling you what happened. Now, before you panic, let's be clear on what actually counts. This is about cash, physical bills, money orders, cashier's checks in some cases, your social security direct deposit, fine. A normal check, fine. A wire transfer, fine. None of that trips this rule. But here's the twist that catches people off guard. Banks add up your cash deposits across the entire day, no matter where you make them. Deposit $5,000 at one branch and $6,000 at another that same afternoon. And the bank still sees $11,000. You can't outsmart it by splitting locations. So who actually needs to worry about this? Two very different kinds of people, and both of them think they're safe. Both of them are wrong. If you're a retiree living on modest, steady income, you probably think you'll never come close to that number. That feels like safety. It isn't, and I'll show you why in a minute. And if you're a retiree with real savings, you're moving pension payouts, consolidating accounts, maybe settling an estate, every one of those moments can quietly raise a flag. Stay with me, because the real danger isn't the $10,000 line at all. It's something smaller, something with no floor whatsoever. There's a second report banks can file, and this one has no dollar minimum. Not $10,000, not $5,000. It can be triggered on $800 if the pattern looks wrong. It's called a suspicious activity report, and it's not filed by a person, it's filed by software. Algorithms scanning your account for patterns that look like someone trying to dodge that $10,000 line. Let me tell you about Noah. Noah is 68, a retired mechanic outside Nashville. He sold his truck for $11,000 in cash because the buyer didn't have a cashier's check ready that day. Noah had heard somewhere that $10,000 was some kind of government tripwire. So to be careful, he deposited $5,000 on a Tuesday and $6,000 on a Friday. Two separate trips, his own money, a completely legal sale. The bank's software saw two large deposits in 1 week from an account that had never held more than $3,000. It filed a report with federal regulators that same day. Noah did nothing wrong, but that report now sits in a database, permanently linked to his name. And here's the cruelest part. The bank can never tell him. An employee who tips off a customer commits a federal crime themselves, punishable by up to 5 years in prison. The silence isn't rudeness, it's the law. So here's the moment I want you to actually pause on. Pull up your checking account balance right now. Not last month's statement, today's number. Because what I'm about to tell you applies directly to it. When most people learn about this $10,000 line, they all get the same idea: split the deposit. A little today, a little next week, just to stay under the radar. That instinct is not smart. It's a federal felony called structuring. Under federal law, it doesn't matter if every dollar you have is completely legal, earned, inherited, or gifted. If you deliberately break a deposit into smaller pieces specifically to dodge the report, you've committed a crime. The penalties are brutal. Up to 5 years in prison and $250,000 in fines for smaller amounts. Up to 10 years if it's tied to other activity. And the government can seize the money before you're ever convicted of anything. You'd have to prove it was legitimate while your money sits frozen. Here's a number that should stop you cold. Federal watchdogs reviewed structuring seizure cases and found that in the ones where structuring was the stated reason, more than 9 out of 10 involved money that was earned completely legally. The law was built to catch drug traffickers. In practice, it was catching honest people who simply didn't know the rule existed. Reforms in recent years have limited how aggressively the IRS can seize funds from legal sources, but the crime itself is still on the books, and other agencies can still pursue it. So the lesson never changes. Never break up a transaction to avoid that line. Ever. Now here's something almost nobody explains. Retirees get flagged more often than working-age adults, and it's not because you're doing anything wrong. Think about it. When you had a job, your money moved in one predictable shape. Same paycheck, same schedule, every 2 weeks. Retirement doesn't work that way. Social Security lands on one date, a pension on another, investment dividends on a third. Then, layered on top, occasional large one-time events, a required withdrawal, a home sale, an inheritance. The software is built to notice variation. And a retiree's financial life is naturally more varied than a single steady paycheck ever was. Add in the fact that many retirees no longer have an advisor sitting beside them, and these situations quietly build up until they cause a real headache. None of this means anything is wrong with how you handle money. It means the system was built around a pattern that retirement simply doesn't follow. So what actually protects you? Not avoidance. Documentation. Let me tell you about Grace. She's 71, a retired school teacher from Baton Rouge. Her brother passed away and left her $38,000 from his estate. She walked into her bank, deposited the full amount in one transaction, and handed the teller a copy of the estate settlement letter naming her as the beneficiary. She asked the teller to note the source on file. A report was filed, just like it always is, over $10,000. Grace never heard another word about it. The paperwork made sure of that. That's the entire principle. Deposit the full amount at once, never split it, and bring something that explains where the money came from. A bill of sale, a gift letter, an estate letter, a pension notice. Keep a copy for yourself. You'll probably never need it, but if anyone ever asks, you hand over an answer instead of scrambling for one. Now let's talk about a few habits that quietly keep you out of trouble in the first place. Stop running your entire financial life through one checking account. Your checking account should hold about 1 to 2 months of expenses, plus a small cushion. That's it. It's your wallet, not your vault. Your emergency fund, 3 to 6 months of expenses, belongs in a separate FDIC-insured high-yield savings account. It actually earns you something instead of sitting there losing value to inflation. And money you won't touch for a year or more can work even harder in short-term treasury bills or CDs. This isn't just about avoiding flags. Idle cash in checking is quietly losing value every single year. Here's one most people never think about. If you're 73 or older and required to take money out of a traditional IRA or 401k, a lot of people take the whole thing as one lump sum in December and drop it straight into checking. That's exactly the kind of single large deposit that stands out. If your plan allows it, spreading that withdrawal into smaller scheduled amounts across the year isn't structuring, because there's no intent to dodge a report. It's simply how the distribution is set up. The difference is intent, and a routine scheduled withdrawal looks nothing like someone hiding something. Family gifts matter here too. For 2026, you can give or receive up to $19,000 per person per year without triggering a gift tax filing. Go above that, and you're generally supposed to file a form, not necessarily to pay tax, just to report it. A simple written record protects everyone involved. 2 more things worth knowing before we wrap up. A single high-income year, a big withdrawal, a Roth conversion, an inherited sale can push more of your Social Security into taxable territory. And separately, it can raise your Medicare premiums 2 years later through something called IRMA. People take one large distribution, forget about it, and get blindsided by a higher Medicare bill years down the road. Spreading big income events across tax years, when you have the choice, quietly protects you on both fronts. And if you're using apps like Venmo, PayPal, or Cash App to sell things or receive money from family, that activity can generate its own paperwork too. It doesn't mean stop using them, it means keep it organized, same as everything else. So here's your simple plan. Before depositing a large sum, gather the paperwork that proves where it came from. Deposit the full amount in one transaction. Never split it across days or branches. Hand the documentation to the teller and ask them to note it. Keep a personal file of anything over $5,000. And if you're moving money between your own accounts, do it as a single transfer with a clear memo line. Above all, never break a deposit into smaller pieces to stay under $10,000. A large, legitimate transaction is completely fine. Trying to dodge the report is the only thing that's actually dangerous. One last thing. None of this means you should start keeping cash at home to avoid banks altogether. I understand the appeal. No reports, no algorithm watching. But it's a losing trade. Cash at home isn't insured. A fire or a theft, and it's gone for good with no way to recover it. And just like idle checking balances, cash sitting in a drawer loses value to inflation every single year while earning you nothing. The answer was never to hide your money, it's to organize it. Clean paperwork beats concealment every single time, and now you know exactly how to do it right.